Welcome to the Funeral Funds Life Insurance Podcast. I'm your host, Randy Vandervate from Funeral Funds of America, and you can find us at funeralfunds.com. That's funeral, FUNDS.com. Whether you're interested in term life, whole life, annuities, disability, business continuation, or final expense life insurance funding, we have you covered. Our team of experienced professionals will guide you through the complexities of insurance products to help you make an informed decision. In this podcast, I'm going to be discussing what are the less common uses of life insurance. Let's dive right into this. Now, a lot of people just think of as life insurance you die and somebody else gets the money. There's really no benefit. Why would I ever want to buy insurance if I'm not going to ever get the benefit? Well, if you've got a family or loved ones that are leaving behind, they're going to be in a tough situation if they don't have adequate funds on hand to replace your income or just be able to take care of the necessities in life. But one of the most often kind of missed things that people take for granted when somebody passes away is they just think that the house is always going to be there. And that's not always the case. So estate planning is a huge part of life insurance planning and utilization. So if you've got the proper amount of life insurance, it's going to ensure the smooth transfer of wealth to your heirs by covering different expenses associated with your estate. And estate can be your house and property and items and belongings and cars and boats and all that stuff. So if you've got a really high net worth and you've got like millions of dollars worth of assets, which I understand that's not everybody, but just hang in there with me. The government will come after certain people with enough money and they'll impose death taxes. Now, the the government it's below a certain amount of assets that it's not a big concern at all. But once you get beyond that, it's a big concern. And boy, I tell you what, there's families and people and families that have worked their whole life and generated some amazing, fantastic levels of wealth, and they don't have adequate planning. And when they pass away, now there's a big tax bill by the government, and in many cases, the family that's left behind has to sell the most treasured assets and some of these properties that have been in the family for, years and years and decades, in some cases centuries, to pay these darn tootin' taxes. So, most people, even though some people have a lot of money, they may not have a lot of liquid money, meaning money just set aside where they can just write a check. So when Uncle Sam comes asking for taxes, they don't have that money. It's tied up in real estate and property and other assets, and they have to sell those. And that can be very traumatizing. And life insurance is a great way to mitigate that tax damage and that liability of having to pay those taxes. So that's from a high income standpoint, but everybody has money problems, right? When somebody passes away, the people need money for any number of things. There's bills that have to be paid. A lot of times there's medical bills. If you're in a married relationship and you've got a couple kids that are younger that are going to have to go to college, those kids are still going to have to go to college, and it's going to be very difficult if you're not around providing income. Also, the other thing about the life insurance proceeds is that they avoid probate, meaning they've been paid with pre-tax dollars. Therefore, in most cases, the beneficiary is just going to get the money, and there's no ties at all back to the account, the estate, or anything like that. So that's really important that, say, a mother and a father both had insurance policies and they named a child as the beneficiary. The child's going to get that money, and that's going to be outside of the state and everything. Now, in most cases, the parents have something in mind for that money to make sure that things can be paid off. Because if all the assets and houses and property and savings accounts and everything are going to the kids, there's going, depending on the amount of those assets, a lot of times things are going to go into probate, and it just gets in the court system. and it takes a while, and it takes money to get that stuff through. So the insurance money can be used to take care of all the legal expenses. If there's enough insurance, you can actually end up paying off the houses and some of these assets and have those free and clear. In some cases, say there's 3 children and one of the children wants the house and the other 2 want nothing to do with it. Say it's a $500,000 house. Well, yeah, and let's say most of the assets are tied up in that house. That one child could get the house worth a $500,000, and then the parents could get an extra policy for $1 million. And then when they pass away, each of the other 2 kids would get $500,000 each. So everybody ends up with the equivalent amount of assets or cash. And that way, you know, so many families are broken up when somebody passes away or an estate, is getting settled because there's confusion about who gets what and what goes where. And families that have been together for years and years and years, their entire lives have been just really damaged when money gets involved. So estate planning is a huge portion, specifically from a parent standpoint, if they're handing money or assets down to children. Another less common use of life insurance is retirement planning. So there's policies out there where you can actually put money in, you can overfund them, whole life, universal life, things like that. And once that money's in the policy, you can now borrow that money out of the policy at any point in the future. Now, we always recommend you pay it back, but you're just borrowing against your own policy. You pay a small interest rate, but you don't have to go through the bank or anything like that. Now, I will tell you, being your own bank, borrowing against your policy, that's typically something that people with higher incomes leverage, typically when they've kind of maxed out all their other investments. So we don't really recommend that in most cases for people who are just getting by, who want to protect a house or replace, income for a couple of years or something like that. In many cases, term life insurance is going to be the better one there. But just keep in mind, there's life insurance products out there that can really protect your family and your state and income earning potential, you know, even after your working years are past. Another retirement planning product out there is annuities. So you may not know this, but all the lottos you see out there, when they say, hey, you won $1 million and you're going to get paid 20 or $30,000 a year for the next 20 years or 30 years, whatever it would be, that's an annuity. They're just annuitizing the payments out over time. So if you've got like some old retirement accounts or something like that, they're just sitting there and stagnating and not getting great returns or anything like that. In some cases, depending on the type of policy and the structure, you can roll that lump sum into an annuity, and now you can have that annuity providing a monthly income to you for the rest of your life. And you can have that start now, you can have it start later in 10 years. There's all sorts of things you can do, but it's a great way if you've got a lump sum that you're really nervous about, say, leaving it in the stock market or anything. You can put that into an annuity, and that will just supplement your income by providing a regular monthly income check in the mail. Pretty cool way of doing it. And in most cases, these annuities are going to offer protection against outliving. So say you had $100,000 and at some point, they'd paid out $100,000. Well, there's protections that can be built within the policy that if you live longer, you know, too bad, insurance company, they got to keep paying. So it's really an interesting concept, and it works well for people that are really just trying to protect some money out there. So another way that's a less common use of life insurance is long-term care. So accessing funds in some of the insurance policies, again, whole life, universal life, things like that, can help offset long-term care expenses, nursing home, healthcare costs, things like that. And some of the term policies out there actually include riders that will protect in case there's any critical illness or things like that too. So just depending on the insurance company and the policy, there's a lot of options out there for that too. And just understand that a lot of this is situational. It's not something that we could recommend to everyone out there, kind of just blanket across the board. It's really on your unique situation where you are in life, but we can certainly help you understand what your options are. And then another less common use of life insurance that at least most people don't think about, if you're in business, you do, is business uses. So you can use life insurance to fund buy-sell agreements to ensure smooth transitions of business ownership. So let's say there's a business out there and it's got two owners, two individuals started this company together. And, unfortunately, one day one of them was driving to work and they got hit by a cement truck and they passed away. Well, when that ownership, that half ownership of the company, now that that owner's died, would go to the spouse. Well, in many cases, the spouse is not involved in the business. They should not be involved in the business. And if they get involved in the business, it's going to be a train wreck that can demolish the business. So, in many cases, you do not want that spouse coming in and having any sort of uh, authority to make business decisions within the business. They're just not the right person. They were married to the right person, but that person's gone. So you can use life insurance that says, hey, if something were to happen, if I were to pass away, you've got enough life insurance there to buy out the other 50%. So each of the business owners would have a policy on the other person and they'd be the beneficiary of that, and then they could pay off the surviving spouse, and that's a better deal for the spouse. They just get the raw money and they just get all this big chunk of money rather than ownership and everything tied up in the business. And in many cases, that's just better for them. They can go on and kind of build and create a new life with that money and do great things with it. And then the other business owner who knows how to run the business can now own the business 100%, hire out for whatever kind of talent that has kind of just, slipped away with somebody passing. So that's a really common use from a business perspective. Another one is key employee, key person. Maybe you've got some people in the business that are really critical to the business's success. And if they were to pass away, it would have a huge economic impact on the business. Well, if that's the case, man, if they pass away, the business is going to need money. Number one, because there's more than likely going to be at least a short-term economic um, detriment to the company where you're going to lose revenue. Maybe it's a salesperson and there's just not as many sales, and the business needs that money to keep functioning. And also, you're going to need money to be able to hire new talent, and kind of just get them through the training period so that they can start again, in a salesperson situation, start making more sales. But maybe you've got somebody that's in R&D, research and development, and it might take a long time to find somebody there, and it might like delay projects by months or weeks or even years or decades in some cases. So you're going to have some insurance just to really make sure that the business continue to function in the long term. So, and then one other thing is, if you've got a business, a lot of businesses have a benefit to just every employee in the business that would pay out 1 times their annual salary if they were to pass away while working, for the company. So maybe you make 50,000 or $100,000 a year. You might have a 50 or $100,000 employer-owned insurance policy. Really nice. Now, in most cases, that's not going to be enough money. $50,000. If you're making $50,000 a year and you're married and you got 3 kids at home, and your spouse and children basically have one more year of your income and then everything's gone. How do they survive then? I mean, just catastrophic loss of funding, not to mention catastrophic loss of, a loved one. So in that case, we would probably recommend like having $500,000 worth of insurance. So maybe you've got 50,000 at work, get another 450,000 to get you $500,000, and that's going to replace your income for 10 years. That gives your family a lot of runway to, to make it. And remember, this is tax free. So they're getting $50,000 a year tax free. Now, when the spouse who died was working, it was 50,000 minus the taxes. So you may have only been bringing home 30. So there's kind of a tax advantage there too. having a little extra money. So, and then really the last kind of less common use of life insurance is charitable giving. So a lot of people, have these wonderful, magnificent charities out there or organizations out there that they would love to help, but just kind of due to where they are economically, they just can't do it right now while they're living. But what a wonderful gift if you got an insurance policy, and when you passed away, that charity or that organization would be the beneficiary of the policy. Boy, I tell you what, if you want to change lives, if you want to, like, take a bad situation and turn it into something good, change a whole bunch of people's lives after you pass away. And life insurance is an amazing opportunity to do things like that. So you can have different organizations be the beneficiary on the policy. You could set up a charitable trust or something like that. If they set up a trust, and then you could have that money go out over a specific period of time. Set up an annuity that's transferable once you pass away, perhaps, and or set that up in a trust where the organization would get that money. There's a number of different ways you're going to do that, and again, that's all situational depending on the insurance company and the type of policy. So just understand that you don't have to be like rich to like make a huge difference in a charity or an organization or other people's lives. So those are just some of the less common uses of life insurance. My name is Randy Vandervate, and I hope this podcast has been helpful to you. Funeral Funds of America can help you qualify for first day coverage or benefits at funeralfunds.com. That's funeral, FUNDS.com. And our phone number is 888-862-9456. We will be blessed to help you with this in the future. Until that day comes, stay safe, take care, and have a nice day. Bye-bye.